So we do have a great panel here today. I'm going to jump right in. Thank you all for being here. To start off, I'd just be curious to hear about how you find profitable opportunities in ESG investing, what makes a good ESG investment, and I guess most curious as to what you think they are as well. Do you want to start us off, Andy?
Sure. Is this working? Okay.
Yeah.
So the New York State Common Retirement Fund's stance on ESG is that it is a tool that can be used to identify investment risks and opportunities. So we don't view ESG as an asset class, nor really an investable entity. And in fact, I think Benjamin Graham's probably rolling in his grave right now, the protege of the Oracle of Omaha, if he realized that there is an actual conference for something that is essentially just a proxy for risks and opportunities. Our mechanism for deploying capital to investments that have this dual objective is through a portfolio that I oversee that we refer to as the Sustainable Investments and Climate Solutions Portfolio. It is a tapestry of investments that overlap with the UN Sustainable Development Goals. There are 9 themes that we target that are split equally into 3 categories: human rights and social inclusion, economic development, and resources and environment, where we have a particular focus. This is all on our website. We have just over 70 investments in this portfolio across asset classes. And the commitment target is 20 billion. Last year when we formalized this portfolio, we're at about 8 billion, and by the end of the year, we'll be at 16 billion. So we've almost doubled the size of the portfolio in less than 2 years, and we're pretty excited about that. In terms of profitable opportunities, I was mentioning this to a gentleman earlier today, that our top global equity manager, just by happenstance, is a sustainable investment manager. And so this is across over 24 global equity managers. And so this is by function of a benchmark. So we identify what is a good investment is, how did it perform relative to its benchmark, along with that other objective of some type of environmental or social benefits.
Sure. Andrzej or Marcy? Yeah. So I'll take a stab at this one. So obviously I'm not an investor working at a rating agency, but I will hazard a guess that an investor does not want to purchase something that then turns around and loses value. So that is the add-in that rating agencies, in regards to the ratings that we assign, that's the business that we're in. We are helped on that path, and I would imagine that investors are as well, when you have really good disclosure on ESG issues, on all of the categories, ranging from climate risk considerations to also looking at the impact of cyber attacks from both a social perspective as well as a governance management strategy perspective. So that is one of our focuses in terms of providing clarity on those particular issues. I'll also take another stab in terms of disclosure, that what's also helpful when I hear about different portfolios and focuses is when you think about the labeled bond universe that's out there. It continues to grow every single year. And what's interesting from my perspective is, particularly my focus has been in the US and public finance, the amount of issuance that is self-certified as opposed to actually having a second party certify the use of proceeds or continuing disclosure. In my universe, I have some issuers that think that everything that they do is inherently green or social, and there's a bit of a disconnect in that regard. So I guess we're the service providers for helping investors to define profit. Thanks.
I think it's a tricky question about profitable ESG investments. I think these days it's not that difficult to find ESG labeled investments, but the question of profits is one on investors' minds. And we have commissioned over the recent years a survey of investors across our global offices. And I found it interesting that in the US, you have a situation where less than a third of respondents expected portfolios with ESG characteristics to outperform portfolios without ESG characteristics. So the level of faith and ability of ESG to deliver returns and deliver profits, at least in the fixed income space, because that's where I operate, is quite limited. But we actually believe that you are in the midst of major trends in terms of major shifts in demand for specific sectors, specific issuers, allocations that will become, I can call it a self-fulfilling prophecy. So a particular group of sectors and industries that might have done well in the past will no longer offer those opportunities in the future because of the self-selection by investors looking through the ESG lens. And that in its own right will also help to bring about profitable opportunities at the expense of those that might miss the mark.
Yeah. So one, ESG opportunities are one thing, but certainly climate, governance, social risks are all are important for every investor, right? And so I'd be curious to hear, and maybe Marcy, you can start us out about how you're integrating ESG risk into your credit risk assessments, into other risk assessments as well.
Sure. So there's a couple of ways that we're doing that. I'll speak primarily to the one area that I spend most of my time now focusing on. Starting in 2019, Fitch rolled out for all of its asset classes what we call ESG Relevance Scores, which are a scoring methodology, ranks from 1 to 5, where we indicate the impact that ESG risks have had on the credit rating, on the credit outcome and the decision that committee has come to. The scoring methodology thinks about, if you think about starting with a score of 1, we're saying that ESG risk is really not relevant to that particular category, that asset class at all. It could be something as simple as water risks for, think of an industry that has absolutely nothing to do with water, to greenhouse gas emissions, things of that like. Governance in our methodology is always scored at a 3, meaning that it has a minimal impact, or it's something that is being managed by the entity, because governance is always something that needs to be considered. And then as you move up the scale, we go into 4s and 5s, with a 5 being you can specifically identify an ESG factor, risk, which has driven a rating decision. Typically, it does tend to be on the negative front, but we do recognize opportunities by assigning positive scores as well. Just to give you a sense of that, in our community development and social lending portfolio, which is basically used to be called U.S. housing, there's a lot of programs where aid is given to federal, to state agencies for housing programs that those benchmarks and that additional aid was not provided, those entities would not be rated as high. So we do recognize those opportunities as well. The other way that I would highlight in terms of how we are conveying these risks on a climate basis are our climate vulnerability scores, which we began doing last year, which looked at particular industries and particular issuers. And they are ranged over a time frame out to 2050, which looks at global warming risk over that time at a 2-degree benchmark, and says, how will you do by the time you get to 2050? At this point, we've done utilities, oil and gas and chemicals, and we're anticipating finishing the portfolio by I think it's the end of next year is what we're aiming for at that particular time. So that's how we've looked at it on the credit side. Another area that I don't spend time in, but our group is now starting to focus on, is ESG ratings themselves, which is looking at the issuer itself that has issued green or social bonds and assigning ratings for how you are operating on an ESG basis. And this was just announced last week, so there's information that's coming out about that. So new forays.
Andrzej?
I think when assessing those ESG factors, climate factors, the two guiding principles we have is first that you have to do your homework yourself. There's a lot of external data that you can download, and a lot of it is very useful. So whether it's from rating agencies or from data providers, but you can't just purely rely on that. And we've found time and time again examples where companies have slipped through the net, got the pass rating in terms of the ESG credentials, and then you had a governance issue that arose soon afterwards, even though if you did proprietary work to check yourself through your analyst team, all of those aspects, some of those red flags could have been uncovered. So we passionately believe in the importance of proprietary work. But we also believe at the second pillar of being flexible in terms of what information we provide to our clients. So you have a range of demands from investors where for some at the kind of most basic end of the scale, they care particularly about ESG integration in your day-to-day process, and that's kind of where it stops. But you can go all the way to investors who, for example, want their portfolios to play a part in reducing carbon emissions or reaching a particular target of temperature rise, capping that. And through that lens, through the work we can do in terms of emissions profile, carbon intensity of portfolios, we can actually tailor solutions for the needs of our clients. So you have a whole variety of approaches from broadly process-related to ones that target very specific in a space that is still evolving, where my standard of what I want to see from an ESG perspective could be very different from another investor's standard.
Sure. I'll add that ESG risks are present across asset classes. And the reality is that the correlation amongst the popular ESG rating firms is quite anemic. It's anywhere from 0.2 to 0.6, 0.7. Now, if you compare that to the credit rating agencies, that's closer to 0.99. ESG data is self-reported, unaudited, voluntary, unreliable. And so to be able to make an investment decision based on those factors is quite challenging. And more broadly, our approach to dealing with credit risk, it was June of 2019, New York State Comptroller Thomas DiNapoli released a climate action plan. And this document outlines a roadmap for our approaching these related risks. And the first component of that is identification and assessment. So they're just areas of the market that we don't think will be particularly accretive in the future. And we just don't want to participate in those areas, and we'll exit those. There's a popular term for exiting investments sometimes. Next is engagement and advocacy. So stock prices typically go up. And so we engage with a variety of companies on a variety of issues, whether it's political disclosures, executive compensation, diversity, inclusion, et cetera. And then finally, an area where I spend most of my time is on investments, finding and sourcing these types of investments. So I would say that there's definitely value in ESG scores and ESG rating agencies, but based on just some of those inherent factors, the quality of the information, it's not as actionable as we would like it to be.
Yeah. I would be curious to hear about these investments that you might be exiting, whether or not it's sort of there are entire asset classes, whether or not there are certain industries?
Yeah, well, carte blanche, our view is that divestment is imprudent. And these are all, I'm making all public statements here. So areas like thermal coal, oil sands, we've made decisions to exit those spaces. And there's a theory by some that by some companies are not including some of these risks, therefore there will be a higher cost of capital, therefore you're holding overpriced securities. And as a fiduciary, if you hold overpriced securities and you want to be a fiduciary for a long time, then you have to be a lot more sophisticated in terms of what you think about how to exit those or hold those. And so the tool that we use most is engagement. And that's been quite effective. If you've been following the news, there's an oil company where we were involved in getting an outcome that we thought was important. So that's our primary tool is engagement.
Understood. Do you see room for EU-style ESG ESG-style regulation? And I'd be curious to hear as well, sort of what you think, if not what you think the regulatory landscape should look like. Andrzej, as somebody who spent time in London and elsewhere, yeah.
Here you go. Look, we had an avalanche of regulatory changes in Europe that essentially is pushing managers to choose what kind of investment products they want to offer. And if they want to offer a specific compliant type of product, they need to have all kinds of ESG characteristics. And that in its own right was an interesting time for the industry because a lot of the guidelines were pretty broad. And managers were scratching their heads about how can they comply with these rules, with some adopting the standards without actually changing much about how they behaved on a day-to-day basis, how the investment process looked like, while others taking more time to study the details and make the determination. So from our perspective, it's unlikely that we will go all the way to the extent that European regulators have shifted in this area. However, where the European experience could be useful is in focusing on credibility of your ESG efforts. Because as you can imagine, now that there's more scrutiny over this area, a lot of greenwashing, a lot of nice presentation slides in your slide decks, rather than actual changes to your investment behavior are easily coming out. And we've already seen examples here in the US with managers being targeted with action that is challenging credibility of the statements in this area. So if there is one aspect that I think will be transported from Europe here in the context of ESG integration, ESG investments, it's to do with credibility of your efforts and whether your public statements, whether your commitments actually match what you do day to day within your investment teams.
Yeah. Marcy?
Oh, sure. I would 100% agree with what Andrzej is saying. I don't, given how long it's taken the U.S. to sort of move forward on, pushing through, even just discussing some of these regulations, I don't think it'll be ramped up to the speed of the EU immediately, or, it's hard to kind of gauge how long it'll take to actually get there. But it's clear that progress is being made, and, we are expecting, supposedly at some point this year, we will hear from, the Fed, we'll hear from the SEC. Well, those will be coming out. We'll have a better sense as to, what type of disclosure or, the climate testing for the banks, what we'll be seeing there. I do know that in terms of learning from other nations and what they've experienced, colleagues of mine that focus on financial institutions have commented on the French banks in particular that the climate stress testing wasn't as fruitful or as open as you didn't get as much information as you were hoping to derive from doing that. So hopefully we will learn from that as well. I would also share, again, just to broaden the conversation is, you still also have the municipal market, which, there's so much conversation about the corporate sector, about financial institutions. There's lots of other asset classes out there also. And it always seems like they come last. And so, but meanwhile, again, if you go back to the statement that I shared before about, the labeling of the bonds, those are some of the same asset classes that could use some additional guidance. So I think that'll be really great when that moves forward. Right now, we just have a lot of best practices documents out there, and that's just not quite enough.
Yeah. Which matches something you were saying earlier, yeah.
Yeah, sure. I mean, there are certainly challenges ahead. This is a wonderfully amorphous space. There is no ESG referee, there's no SRI referee or impact referee, and as a result, policing and regulating this space is going to be quite difficult. If you think about SFDR, the Sustainable Financial Disclosure Regulation, was adopted in November of 2019, kind of sputtered out of the gate this year. So that is a signal of what likely will happen here domestically. The Department of Labor bulletins in 2015, during one political administration, 2018, and then 2021, are all saying particularly different things. The recent SEC risk alert also shows that there may not be a total grasp of some of these issues. And so I don't think regulators want to make a mistake, but it will be kind of hard to regulate. And I think it's going to require a lot of asset owners to be much more aware of this term called greenwashing, or these unsubstantiated claims. So for example, with us, sustainability-linked bonds are quite popular. However, the sources and uses of cash don't necessarily have to be tied to some type of environmental activity. And so we don't count those as sustainable investments. If we invest in them, they'll be purely for financial reasons. And it's the asset owners that are going to have to probably address this, because that's what managers are going to respond to.
I think Andrew is making a very good point about the labeling, where we offered instruments that are called green, they're called social bonds, they're called sustainable bonds. But often when you check under the hood, the commitments that are contained within those often are quite vague. We recently had an example of a utility company whose commitment they've already met.
Right.
So they're bringing a new security with a forward-looking commitment that will require zero effort from that issuer. So the importance of doing due diligence and not taking those securities at face value is critical.
Yeah. Switching tracks a little bit, I was curious to see in President Biden's infrastructure plan that a lot of the infrastructure programs are being paid for by with government money. That we have this maybe increasing, that we're increasingly comfortable with a growing deficit with government spending on projects like this. And I was curious what role you think the private market plays if there aren't necessarily sort of public-private partnerships in the same way, whether or not this is a trend that's actually going to last. Would be curious to hear your thoughts on this. Do you want to start, Andy?
Sure. So the 1.5 degree or 2 degree scenario, I think we are off track for that. And I think that there are going to be, 3 avenues that investors and managers will have to take if we're going to even get close to addressing the climate risk. And one of them is going to be removal. Removal of carbon. To some investors, it's like a science project right now. And so the funding to make institutional products from that, I don't know how far away we are from that, but I don't foresee this achievable without some type of removal. Now, when it comes to avoidance, I took the train here, so we definitely can avoidance, there's opportunities there. And then also mitigation, which relates to resource efficiency. Those three, removal, mitigation, and avoidance. A lot of the recent statements from the White House have been done through executive order. The political quagmires that that this topic will embroil others in, I'm less optimistic, but maybe my fellow panelists have different views.
So I would share, getting to the heart of your question about paying for the infrastructure through private dollars, I would shift and focus on the outcome of climate change. And if we think about the increase that we've seen in natural disasters, in the U.S. in particular, let's just focus there. We always come back to FEMA. Well, FEMA will step up to the plate. They will take care of it. But it's not just FEMA. It's HUD. It's small business. There's lots of agencies that have to get involved. But if you see the increase that we have been, if this continues, this propensity for disasters that are costly, that affect more people over time. We just had the flooding just a few weeks ago. I don't know if anyone saw any of the videos of my town, Mamaroneck, where such destruction took place there. This is just right around the corner. So let's focus on the costs that are because of that, and the billions of dollars that FEMA has to contribute. People, I don't know that they're focusing so much on what that does to the budget and to the deficit in terms of every single year, what we're seeing there. At a certain point, you do need to step in. You do need to think about building resilience. You need to work to mitigate what those disasters are going to cause, and get in front of it, not behind. And you see the different proposals. We can talk about Miami or Charleston in terms of the walls, even New York City, what we are going to do in terms of seawalls. And people are opposed because it doesn't look attractive. We need to sort of get beyond that, and then also think about investing in building resilience in this country.
Yeah.
And I wonder whether the benefit to forming some public-private partnerships is going to become obvious over time. We've gone through a period of fiscal largesse that is not going to last forever. The ability of the governments to write checks will diminish over time, because we have to realize that we're saddling the next generations with greater and greater amounts of debt. So there would be a natural desire, therefore, from the governments to find some way of connecting the private sector with all those worthy projects that are very NPV positive in terms of either mitigation of losses or genuinely improving living conditions and the environment. So flipping that argument on the other side, from a private perspective, there equally should be increasing demand for those kind of opportunities. We've been talking today about the explosion of alternative investments, how your traditional equity fixed income portfolios might be a thing of the past and being replaced by alternative investments. So with savings pools at historically high levels, the opportunity to channel some of those investments into this sphere is obvious. And if there is a clear framework that determines some predictable rate of return around such investments, I think that should be helpful to attract a lot of infrastructure or other kinds of alternative investments over the years to come.
Yeah. And you mentioned something very interesting, the 1.5 to 2 degrees, of warming. You said that we were sort of off track for that, and mentioned a couple ways that we could potentially sort of. I think that nobody would say that that private markets are wholly responsible for getting us there. There have got to be other solutions as well, but. you mentioned a couple things, about how investors, how private markets could play a role in getting us there and getting us on track. Does that seem, I guess I would be curious to hear from the rest of you as well. Does that seem feasible? What steps can investors take? How much of a role can investors play in getting, in mitigating a disastrous level of warming?
Yeah, well, from the standpoint of identifying sustainable investments, the overarching theme is that there are these secular trends that we believe will be accretive in the future. So there's population growth, climate change. There is perhaps a relationship between those two. And as I think about our investment portfolio and going through the asset classes and the number of opportunities that we're seeing, it's very encouraging. And so these secular trends actually are persisting, and unfortunately there's no vaccine for climate change. So the private markets do have an opportunity, and infrastructure is an area that looks really interesting now. And one item that I think has helped us out is that our expectations for the sustainable investments, they're underwritten in conjunction with the asset class teams. And so there are certainly a lot of exciting areas that may not provide the requisite risk-adjusted returns that we desire. And I think that's a result of competition. So the space is actually becoming more and more competitive. And so perhaps the riskier investments are the ones that may be in play, though we'll have to identify those if they're ready for prime time, so to speak.
So I guess I would share two things in terms of a rating agency and how they become involved in that space is really just signaling if a particular issuer is not addressing those risks that have been identified, what the outcome, what the change could possibly be to their credit rating. It's credit risk. If you do not step up to the plate, identify the risks, figure out how you're going to transition through this time period and where you're going to land at the end, there will be deterioration in credit quality. That's how the path goes. The other thing that I would share, putting on my infrastructure hat, is I had a conversation recently with our head of our infrastructure group, and we were talking about ESG risks in the infrastructure portfolio. And in terms of our relevance scores, we assign them to public international ratings. The private portfolio that they cover is quite broad, but the relevance scores that we share are just for public ratings. And I was trying to get a sense as to, well, why are the relevance scores, why don't we see more elevated relevance scores then for infrastructure? And what he shared is that, in order to achieve an investment grade rating, when these projects are walking through the door, that is boxes that the sponsors, that the project developer, they've already gone through all of those issues and identified them and figured out how they're going to mitigate them, how they're going to address them moving forward, because they don't want to walk in, start out with an investment grade rating if they're able to get there, and then move down into the non-investment grade universe. That's not where they want to be. But on the other hand, there's a lot of private development that's taking place out there, and they're not addressing those risks. And we'll see what happens in that regard.
Yeah.
And I just think that it's an area of both risk and opportunity, like risk in terms of corporate policy being out of step, financial policy being out of step with a more holistic approach to not just the lens of your P&L, but also the approach to a broader range of stakeholders you have. And that is something that companies will be challenged over. But with that also comes opportunity, and opportunity is around new technologies, new processes, new ways of doing things that can lead to meaningful shifts in demand, meaningful creation of new job places. We're looking at renewable energy. The cost of making solar batteries, the cost of making wind turbines, biomass, that has collapsed over the recent years. And a lot of that because of the private investment that spearheaded technological change that allows us to do better, to actually maybe close the gap to the goals that we have set. So this is not just about the stick. There's also a carrot of opportunity that the corporate world and asset owners and managers alike should take into account.
Okay. Unfortunately, I think that's all the time that we have for today, but thank you so much for your time. Thank you.